Have you ever wondered what's really going on inside the minds of India's top investors? Well, we've dug into the playbook from the sharks themselves on how to build, pitch, and scale a business in today's world. Let's just jump right in.
But first, I've got a question for you. Imagine it's all gone. All you have left is 1 crore rupees. What's your comeback plan? How do you spin that into a fortune? Go ahead, pause, and really think about it, because we're about to find out how the pros would play this exact hand.
So, what would the sharks do? Their answers are fascinating because they show 2 totally different but equally brilliant ways to think about building a business from scratch.
Now, check out the difference here. It's pretty amazing. Piyush Bansal, he goes for a tactical, data-first move. He'd find a niche on Amazon, use their massive system, and start making money, fast. Namita Thapar, she's playing the long game. She'd put her money into a huge, mission-driven field, like health tech, trying to solve a really fundamental problem in India. 2 different paths, both leading to the top.
And Aman Gupta just hits the nail on the head here. What he's saying is that today, more than ever, if you can spot a real need and carve out your niche, the money and the support system are there to back you up. It might be easier to start, but that means you've got to be more focused than ever before.
All right, so you've got your idea. Now comes the really hard part, getting someone to actually write you a check. What is going through a shark's mind while you're standing there pitching? I'll tell you this, it's not always what you'd think.
Ritesh Agarwal just puts it perfectly. He's not just investing in your slides or your business plan, he is investing in you, the founder. He's looking for someone who's sharp, who's resourceful, someone so obsessed with their business that they can steer it through any storm. You know, the ship itself can be fixed, it can be rebuilt, but the captain, they're irreplaceable.
But look, passion will only get you so far. For Vineeta Singh, it all comes down to the data. If you can't talk fluently about your own business's numbers, it is a huge red flag. It tells her you don't really get the fundamentals of what you're building. So, which numbers are the most important?
So what are these critical numbers? First up, your gross margin. Simply put, how much profit do you make on every single item you sell before you pay for other stuff? Next, your repeat percentages. This is huge. It shows how many customers are coming back for more, which proves you've built something people actually love. Then you've got customer acquisition cost, or CAC. How much do you have to spend on ads to get 1 new customer? But as Vineeta says, the real genius is knowing which of these numbers is the one true guide for your specific business.
Now for Namita, it really all boils down to one question. Can this business get huge? As an investor, she's always got the end in mind, the exit. And that only happens if there's exponential growth. For that to be possible, she needs to see 2 things: a massive market to play in, and a really strong, unique selling point that your competitors can't just copy tomorrow.
Okay, so you did it, you got the deal. The handshake you see on TV, that's just the beginning. The real work and the real value of having a shark on your team starts the second those cameras turn off.
And this story just illustrates the shark effect perfectly. Take Rare Planet. They came on the show with just 4 airport stores. Now, Namita didn't just throw money at them, no. She helped them fix their pricing, she opened up her network for their next round of funding, and she completely overhauled their social media. And the result? They went from 4 to 50 stores, and she got a 3.5 times return in just a year and a half. See, that's not just money, that's rocket fuel.
Aman Gupta points out another massive challenge, getting from a 100 crore business to a 1,000 crore one. It's a completely different game. The stuff that got you to 100 crores just will not get you to the next level. That's where a shark's deep experience in branding and marketing becomes absolutely critical to help a founder smash through that growth ceiling.
But before you can even think about scaling, you need this one thing: product market fit. And Piyush gives this fantastic no-fluff definition. He says you know you have it when your product gets listed on a new platform, say like Zepto, and it just flies off the shelves by itself. No pumping tons of money into ads. His rule of thumb is great. Your ad spend should be less than 10% of your revenue.
So we've just talked about the insane value a shark can bring. But what happens when that partnership never even gets off the ground? We all see the deals on TV, but we hear that so many of them never actually close. Let's pull back the curtain and see why that happens.
So there are pretty much 3 main reasons deals fall apart after the handshake. First, integrity. The numbers they pitched on the show, well, they turn out to be way different when the accountants start looking. Second, governance issues. Maybe a founder forgets to mention they're running another company on the side, creating huge conflicts. And third, and this happens a lot, is a practical one.
After the show airs, the company blows up and they get a much better offer from someone else.
So we've seen how they invest in other people's companies. But what about their own money? How do they apply these same ideas to their personal wealth? Let's take a little peek at how the sharks manage their own finances.
So let's look at Ritesh Agarwal's portfolio. And this is outside of his OYO shares. A whopping 45% is invested right back into the startup world. I mean, that is some serious conviction. Then you see a solid 30% in the stock market, basically a bet on the wider India growth story, and the rest is spread out in debt and gold for some stability.
And this slide just shows there is no single right answer for building wealth. You've got Ritesh and Vineeta who believe in the founder's bet. Go all in on your own company, because that's where the real magic of compounding happens. But then Aman comes in and shares that his single best investment ever was actually a piece of real estate. The real lesson here? You've got to understand the game you're playing.
So why do they take so many risks on these tiny early companies? It all comes down to this number, 1. In the world of venture investing, you live by something called the power law. You might invest in, say, 15 or 20 companies. Most will fail or just break even. But all you need is that one home run that returns 100 times your money to pay for all the losses and deliver incredible returns. That's the whole game.
We've covered a ton, from comeback plans and pitch secrets to their personal finances. So the last question isn't for the sharks, it's for you. After hearing all of this, what is the one single thing you're going to change or apply to your own business, your career, or your investments starting tomorrow?